If your goal is to pay more taxes than you need to in retirement, well, you're in luck. Most people do without even realizing it. Now, what's the worst part? It all feels fine until the bill shows up and it's too late to do anything about it. So, this video is going to break down the 5 most common ways retirees accidentally set themselves up for massive tax bills and how you can avoid it. So, between retirement and RMDs, there's often a significant hidden tax opportunity, but most retirees miss it. And I'm wondering why that window is so often ignored. I want to look here. Along the left, this is an estimate of a client's total taxable income, and along the bottom, the client's age. And let's say they retire at 65, okay? So what's typical is their taxable income's pretty high or around the highest it'll be in their peak earning years. Then they, boop, retire. Maybe there's some cash that they're living off of, some non-qualified money. Things like Social Security or pensions haven't kicked in. And things start to kick in. They hit RMDs, and we see this kind of steady increase to the end of their plan. Well, there's a really unique window, guys, right here where their tax rate might be lower than it'll ever be in the future. It's one of the few times you may have control over realizing income at lower tax rates. But what do most people do? They get excited. I've never paid so little in tax. Meanwhile, their IRA balances are ballooning and RMDs kick in, and they are off to the races at a higher tax rate than they ever were before. And the worst part is this window is closed. They can never go back and realize income at this lower window, right? Let's say for this client, they could have done Roth conversions at the, let's say, 12% federal here, where in the future they may pay 22 or 24% on that same money. Maybe they had a chance to get ahead of these big pre-tax IRA balances in order to not just reduce or flatten off their future tax rates, but also their Medicare income-related monthly adjustment amounts or their Medicare premiums. It's critical to take advantage of years where your tax rate might be lower than it ever will be in the future. So the second idea, if you want to maximize your tax bill in retirement, is just keep giving to charity the old-fashioned way, right? You want to be generous, but you also want to make sure you're supporting the causes you love, not the IRS. Let's take a couple here. They want to make a $5,000 gift to charity. Wonderful. Well, the reality is their total itemized deductions are just pretty low. And given how high the standard deduction is in 2025 for a couple here, plus any senior exemptions with the one big beautiful bill, they're just not going to realize any benefits from a tax perspective if they give via cash or check to their charity. Okay. Well, what might some tax smart ways to give be? Well, one idea is through a qualified charitable, I'm going to do Q, CD, a qualified charitable distribution directly from their IRA once they're over age 70 and a half. Well, how does that help them here? Well, get this. The money can come out of the IRA tax-free. It can also, I'll sneak back here, satisfy the RMDs once you are RMD age. Now, do they get a deduction for the amount they contribute? No, but it wouldn't have helped them anyway. They get something better. They get to pull money out of the IRA totally tax-free. So that's a significant advantage. Well, what about, I'm not 70 and a half, I don't want to give cash, but I do have some appreciated stock. Well, what can you do then? Let's say this person has, boy, forgive the spelling, $5,000 in current market value, and they, back in the day, bought it for $2,000. That's their basis. Well, you know, that is a $3,000 embedded cap gain. And let's say that their long-term capital gains rate is 15%, so that's a $450 dollar embedded tax bill that they owe. Well, they can give the $5,000 directly to the charity, not pay any taxes on the capital gain. Now, they still get the charitable deduction, but in this case, it won't really help them. Again, their itemized is so far below the standard, but it's a way to give and get rid of that embedded tax bill that they would have realized if they used the money in the future. So far, we've seen how unintentional giving can trigger unnecessary taxes. But how ready is the rest of your tax plan? I want to invite you, click the link in the description. It's a quiz I made where you can see and assess your retirement readiness score. It's out of 100. It's 20 quick questions, and it will help you pinpoint tax traps and planning gaps before they cost you. And by the way, you'll see your score instantly, no email required. But let's jump into number 3. So, number 3, way to pay the most taxes in retirement. Here's what I do: let all your income hit in the exact same year. Right? You need income in retirement. I get that. But how you layer it really matters. Okay, let's go back to our example from our very first situation here. Let's say instead of having Social Security or pensions delayed, they have it all start right away. Boom, I'm retired. I'm turning all my income sources on, and here we go. Well, they never really experience any meaningful drop to their taxable income like we saw in the previous example. They may not need all of the income sources on, so suddenly they have this excess cash flow, and that's not necessarily a problem. But what if they were more strategic? What if they recognized the RMDs that were coming in the future? And what if they said, I'm going to delay Social Security to an age 70? Maybe a pension they choose to delay as well. Well, now what might have happened is their taxable income could have dropped. Things start to kick in and it gets back up to where it might have been, even exceeding. But let's say they strategically used this window to do what? Roth conversions. They intentionally captured income, say at the 12% federal bracket, knowing in the future, 22 or 24 or higher was their fate. Well, now it can almost flatten this tax rate over time such that they begin, in the end, capturing a delta in tax savings because they didn't need all the income. They didn't rush to turn all the income sources on, keeping their tax rate high and locking in their fate over time. Alrighty, tip number 4, if you want to maximize your retirement taxes, here's what I do: sell a bunch of stock that has an embedded capital gain all at once because you need the money with zero planning. Okay, here's an example. Someone has Apple stock, and let's say they have a $50,000 basis in that stock, the amount they bought it for originally, let's say, and it's currently today worth $250,000. Great investment, nice work. We know, though, that they have an embedded $200,000 long-term capital gain. We also know that capital gain sits atop other income sources that you have from a tax perspective. So here's our handy dandy chart that we've been looking at, right? Their taxable income on the left, their age on the bottom. Well, let's say they're going along. Here's sort of their standard baseline where their plan exists. And they say, well, I'm going to sell this because I'm buying some property, some land, a boat, whatever it might be. What happens in that single year? We see this tremendous spike in income and a return to their baseline. Well, what did they just do? Maybe they would have had the ability to realize a portion or some of those capital gains over time in the 0% capital gains bracket. But because they decided to sell it all in 1 year, a large chunk of that capital gain would now be taxed at the 15% bracket. What else might they have done? If we get rid of that illustration a second, it's not just the federal capital gains tax, it could also be the Medicare premiums. Let's say these are the various IRMA or Medicare premium thresholds. Again, it won't quite line up with where we had the capital gains brackets, but you get the illustration. Instead of spreading this capital gain and taxable income out over a series of years, they spike it in 1 year, causing their Medicare premiums 2 years from now to be an unpleasant surprise, potentially hundreds of dollars more per month per person if they're married. So, the better approach is to be really intentional about realizing capital gains in the context, excuse me, my pencil's flying, in the context of your overall plan and an understanding of your overall tax picture. All right, so finally, number 5 way to maximize your retirement taxes. Get this: following the rules feels responsible when it comes to your RMDs, but does taking only the minimum really protect your legacy? Let's take a retiree here. She's in her mid late 20s, let's say. And each year she's proud to follow the rules and take exactly what she needs as her RMD. But she's spending less than she has and is anticipating leaving behind a large chunk of money to her kids at the end, let's say. Well, the minimum distributions, all she's doing really is delaying taxes, not reducing them. And by keeping her IRA large well into her 80s means bigger RMDs into the future for her. And it could mean for her kids, think about the Secure Act. The kids are going to be required to withdraw whatever's left over here over a 10-year period. Now, why are we interested in that? It's likely when she passes, her kids, let's say they're mid late 50s, early 60s, perhaps they're in their highest earning years. Translation: the tax they pay when they're forced to take this out over 10 years might be the highest tax rates they ever experience in their life. Maybe that's not the legacy you had in mind. So it could be a combination of strategic giving or gifting. Maybe you intentionally are taking more than the RMD would require, thereby flattening the actual amount that your RMD is increasing every year because you're intentionally spending down those IRA balances before you find your tax rates being driven higher. So you just saw how easy it is to trigger unexpected tax bills in retirement, especially if you don't take advantage of low tax windows before those RMDs start. But what does it actually look like to use those years strategically? And how much of a difference can it make? Well, I'd encourage you to watch this case study where I walk through a couple's real portfolio of $1.2 million and then show them how smart Roth conversions could save them over 400 grand in taxes in their lifetime.